Hello, everybody. Mark Zachary, Next Step Home Loans. Hope you're doing well this week and hope you've had a great week. I'm here with this week's market wrap for the week ending March 18th in 2022. So, as expected, the federal or the Feds met on Tuesday and increased the federal funds rate by 25 basis points. So they increased it a quarter of a point, and that was to be expected. It was already built into the market pricing, actually. But what's more important is what are they thinking going ahead? And is what has impacted the market the most. Where originally we had thought that they had plans for 3 more meetings this year, they've actually upped it to 6 more meetings this year. And we're expecting them to raise the federal funds rate, if not every time, certainly several times through this year. So they originally thought that they would only meet 3 times. And I've made a lot of notes here because there's a lot of data that I wanted to share with the market and just show you what's going on with the market. But these increases in the federal funds rate, you'll hear a lot of news and commentary from people that, well, it's raising the mortgage rates. And I see that all the time with real estate agents, title companies, and even other loan officers saying they're raising the federal funds rate to raising the actual interest rates on mortgages. And it's entirely not true. What they're trying to do is curb the inflation that is, at its highest level since 1980. So when they slow down inflation, it will actually help mortgage rates. But until these inflation numbers get in control, then these mortgage interest rates will continue to go up because inflation drives mortgage rates. They are the arch enemy of inflation is the arch enemy of mortgage rates. So they'll keep going up as long as inflation is out of control. Now, one thing that they're doing or watching is the inverted yield curve that I'd mentioned before. That earlier this week was about 27 basis points. And today it is now down to 20. And when that inverts, when the 10-year is higher than the 2-year, then that normally signals a recession is on the horizon. And so that gap between the 10-year and the 2-year continues to get smaller and smaller. So a good indication of a recession is the unemployment rate. And then a lot of people think that the recession hits when unemployment rate is high, but it's actually just the opposite. Recession normally hits when it's at its lowest point, and we're at one of the lowest unemployment rates in a long time. So what happens is the unemployment rate gets very low. The inflation starts to slow down. That slows down the economy. There will be layoffs at different departments our industries because of the slowdown in the economy. And then it just trickles down and the unemployment rate will get higher and higher from that point. We don't know how long of that is going to last, how long it's going to be before that recession rears its head. But we certainly see that coming if the rate gets to be an inverted situation. Now, that is good for mortgage interest rates. It's good for housing because housing has typically done very well in recessions. So it's good for mortgage rates. That's obviously bad for anybody that may be losing their job during that time. But if you're having to buy a house now or wanting to buy a house now, just understand you'll probably be refinancing that mortgage within a year to year and a half. So you don't want to pay a lot of points for a lower interest rate right now, because you're never going to see never going to see understand the recovery of that money being spent, because you'll refinance it before you realize the savings. Some data that I wanted to share with you today: 870,000 homes on the market in February versus 860,000 in January. Still record lows. If you look at that as the month of supply, in regards to sales, that equates to 1.7 months supply of houses. Rents are up 12.6% this year over year. Existing home sales, which is about 90% of the market, was down 2.4% year over year. Investors made up about 19% of all transactions in February. In January, they were at 22%. Cash buyers have gone down from 27% to 25% in February. And first-time home buyers are up to 29%, and it was 27% in January, and that reached a high number of about 33% previously. The average days on market, get this, average days on market is now 18 days. So a home gets listed and then sold within 18 days of putting it on the market. That's a tremendous time frame. It's just crazy how fast houses are moving. Housing starts are up 22% year over year. It's the highest level in 16 years. And of those, single families were up 14% year over year. So maybe inventory levels will be getting a boost there in the coming market. I mean, in the coming months as the market puts more houses on the market. So that's it for this week's wrap. Hope you guys have a great weekend. Hope you have a safe weekend. Pass this out to anybody that you know that may be helpful for them. But otherwise, we'll see you next week on this week's Market Wrap. Have a great day. Bye-bye.